recessions need a shock. They need something bad to happen. And until that something bad happens, a slowdown is likely. But then let's stop paying attention to next quarter's numbers and start paying attention to why is long run growth cut by half. Americans have lost 25% of their income. If we'd kept growing at 4%, like we did till 2000, we would each be 25% better off than we are today. And this keeps going, and it's disastrous for the long run.
What causes inflation, changes in the price level of assets, and what is the federal government doing right now that could impact our lives, the economy, and the price level? We're here to talk about the fiscal theory of the price level with our next guest, John Cochrane. He is the senior fellow at the Hoover Institution at Stanford University, and he was previously the professor of finance at the Chicago Booth School of Business. Professor Cochrane, welcome to my show, The David Lind Report. Awesome having you here today. Thank you for being here.
Thanks. It's great to be here.
Before we talk about economics, I've always wanted to know, why is your blog called The Grumpy Economist? I've had the pleasure of speaking with you a few times. You're not grumpy.
No, I'm not, except on occasion. One Sunday morning, my kids were hanging around, and I made the mistake of reading a Paul Krugman op-ed in the New York Times, and I spilled my coffee and delivered one more lecture at the breakfast table, and my kids dubbed me the Grumpy Economist. Actually, they had funnier names for me that can't be done in public, but that was the one that stuck that could be done in public. So that became the name of my blog.
Well, temperament aside, you are a great economist, one of the best in your field, John, and we appreciate you being on the show today with us. I want to talk about first your book, the major themes of your newest book, The Fiscal Theory of the Price Level, which came out earlier this year. So congratulations on the book launch. Let's start by talking about some of the major themes of your book. It is, it's rather long, and it's a rather more advanced read for those of us wanting to pick it up. It's available. But, the introduction states the purpose of the book quite well, which is what determines the overall level of prices, what causes inflation, deflation, currency appreciation, and devaluation. These are simple questions to a very big theme. Just because they're simple questions doesn't mean they're easy to answer. So I'll let you answer what causes inflation, deflation, and the appreciation of currency per the fiscal theory.
Thanks. Yeah, they are. Most things are obvious in economics. If there's a frost, the price of oranges goes up. But the overall price level is one of those ones that I do as an economist because it's fun and it's not so obvious. I do want to thanks for the plug. The book is called The Fiscal Theory of the Price Level. It's full of equations as well as interesting prose. But for interested readers, I would first go to my website, which is easy to find. And you'll see, along with Fiscal Theory of the Price Level, there's a couple of essays available for free. One called Fiscal Histories in particular, that from the Journal of Economic Perspectives, that introduce the ideas with no equations and sort of cut to the chase of how do we think about current events. It's important to persuade fellow economists with equations, but I think that's a good place to start. And then do buy the book and read the part that you like and put it up on your shelf to impress your friends and neighbors. But start with the easy, free essays. Always give something for free, right? So back to your question. Where does overall inflation, prices and wages come from? Fundamentally, when does the value of the government's money go down? The fiscal theory has an answer to that question, a new answer to that question. It comes from when there is overall too much government debt, both money, which is a form of government debt, but also government bonds, which just promise more money. When there's more of that stuff, then people think the government will be able to or wish to repay. Then they want to get rid of it. It's overvalued. It's not, it's like an asset that is stock that doesn't have good dividends. So what do? You try to get rid of it. And the only way for us collectively to get rid of government debt is to try to buy things with it. Individually, you can sell it to somebody else, but when there's no greater fool, we collectively have to try to buy stuff with it. And when we all go out and try to buy stuff, what happens? The price level goes up. So that's the theory. It's only remarkable in contrast with other theories that give you different mechanisms. But I think that mechanism should be pretty clear. And I'm the luckiest economist on the planet I wrote this book and turned in the draft in March 2021 when there was no inflation. The introduction said, well, we haven't seen inflation since the Reagan era, but who cares? Someday, put this up on the shelf, dust it off. And little did I think the government would do exactly what I told it not to do, print up $5 trillion of money, hand it out, and get inflation. But we did just that, and I was even luckier to have a chance to revise the introduction before it came out.
I just want to make sure I get the theory right for our audience. Are you saying that the level of government debt and or sovereign debt could be used as a leading indicator of the CPI level?
No, but That's a deep and great question. The fundamental mechanism is overall amount of government debt relative to what we think the government will pay off over the long term. And that can be decades. It should be decades. When you have 100% debt to GDP, you should work it down over decades. That does not mean that today's debt and today's deficits matter tremendously for inflation. And that's a lucky thing, because if you look historically, 1 year's debt or deficits have been terrible forecasts of inflation. So I would hate to have a theory that would be so obviously contradicted by the facts right off the bat. So no, it depends on the long run forecast. And in fact, our government can and often should borrow tremendous amounts of money as long as there is a plan for paying it back over those years and decades, and faith in a plan for paying it back with steady primary surpluses over years and decades. The problem happens when that faith in the long run ability to repay vanishes, which can also happen on its own. You can not run any extra deficit or have a particularly high debt, but people say, this is going south. And the next thing you know, have inflation. Argentina has debt crises and inflations at 40% debt to GDP. We about 100% seem to be where we ran into trouble. The UK too. Japan's sitting around at 250% and hasn't tested their limits yet, but we'll see what happens there. There's no easy too much debt, easy too much deficits. Sorry, life isn't that easy.
So walk us through the monetary transmission mechanism here. So the government racks up debt. Debt is high or deficit is high or both. How does that translate to the business and ultimately the consumer?
In sort of the obvious way. And let's take what happened during the pandemic, which turns out to be a gorgeous episode for fiscal theory. The government literally did print up $3 trillion of money, borrowed $2 trillion more, and sent checks to people and businesses. Crucially, the government also did not say, and here's our plan for paying it back. They were actually pretty decent about this in 2008. I made fun of them, as did others, but they did say stimulus today, debt reduction tomorrow. We're going to pay this back. This time, the budget rules were suspended so that spending does not have to come with offsets from taxes or cuts in future spending. All the talk was about modern monetary theory and low interest rates and how we never have to pay back debt. So the debt came, they gave us the cash, and there was no talk about, no plan about how we're going to soak up that cash in the future. And what did people do? They went out and spend it. It was, and that's, they spent it and didn't save it. What the puzzle is, people talk about why do they save so little? Why is there so much intergenerational lack of wealth and so forth? Well, you got checks for $15,000, $20,000. Why didn't you leave that in the bank account and let that be the foundation of building some wealth and getting out of debt? No, people spent it. And that's the crucial decision. People didn't have faith that this stuff collectively. People didn't have faith that this stuff is a great investment vehicle to hold on to. I'm
curious as to why you think that the government debt, this is a big question, skyrocketed to the amounts that we have today. What is the purpose of the government collecting, if you may use that word, so much debt? Is it to expand the economy? Is it to pay off previous debt levels? Is it to help the citizens in some way? What is your thesis there?
Well, now you're getting me into politics, which is dangerous because I don't have any expertise anywhere there. A lot of it is, so you said pay off previous debt. We do roll over debt constantly, and that's a danger. We are like a family in 2006, too young for you, but it's still just before the financial crisis. Lots of people said, the house prices will never go down. the teaser rate is, let's get that adjustable rate mortgage, and it's all going to turn out great, and then it didn't. Our governments do that too. Why are we at the situation of such high debt levels in our governments? I think some of the similar psychology happened politically. People who worried about the upcoming debt crisis have been wrong for 20, 30 years. Now, people who point out that we live on an earthquake fault in California have been wrong for 20, 30 years too. That doesn't make us wrong. That just, means it took a while. But governments, like households, tend to look at the short run, and the short run is the debt service costs. And when interest rates are really low and the Chinese government is just banging down the doors to buy more of your debt, and there's no sign of the bond vigilantes, it's very tempting not to do the hard stuff of, we want to spend money on all sorts of worthy causes and anxious voters, and we don't want to raise taxes on them, but we can borrow money. And from 2010 until last year, governments were borrowing at negative interest rates, real interest rates. They borrow it at 0 to 1%. Inflation's 2%. The world is paying 1% in real terms for governments to take their money. Well, wouldn't you? If someone offered you could borrow $25 trillion and we'll pay you 1% a year to take it, it would be awfully tempting to borrow money instead of working harder to pay for that new Lamborghini you've always wanted. And I think governments did the same thing.
Professor Cochrane, is there no constraint to the amount of debt that any government could take on? Because presumably if interest expenses get too high, couldn't you just borrow more money to pay off those expenses? I'm just postulating.
Well, that's where there is a constraint. In the end, people do need to believe the government can pay it back. And the question, that's a good question you asked. Where and how do you start to feel that constraint? And I think you start to feel it in debt service costs as the government, and you start to feel it in inflation as the government borrows more and more. The opportunity to borrow at low rates vanishes. And I think that's what, a lot of the debt service costs our low crowd missed, is that's a nice opportunity so long as you don't use it. But as soon as you start over borrowing, then either you run into inflation or markets start asking more and more interest. And they tend to do that suddenly. When Greece went under in 2010, it wasn't because it borrowed a lot of money. It had debts that it could service at low interest rates. And then people grew worried and started charging high interest rates. And all of a sudden, it couldn't pay those high interest rates anymore. So that's, I think, the mechanism governments will feel is difficulty in rolling over debts, interest rates spiking, and then the interest costs going up. That's one of the mechanisms that they feel when they run out of room. The other one is inflation. Just mysteriously, sometimes inflation, people lose faith in the government. What do? They try to get rid of the debt, and inflation breaks out, even though there's, the government says, we didn't do anything. Where did this come from? Well, they lost faith.
Let's talk about how to fix the inflation problem that we had while inflation's still coming down. But, I'll let you evaluate whether or not we still have an inflation problem. But before we do that, I want you to please evaluate some government initiatives to perhaps fight inflation. Last year, Senator Elizabeth Warren, she proposed the Price Gouging Prevention Act, which is a bill that, if enacted, would allow the FTC and state attorneys to enforce a new standard. I'm just reading the bill, to charge sellers against excessive price gouging during periods of exceptional market shock, were their words. And it would, further down the bill, it says, target dominant companies that have exploited the pandemic to boost profits. The bill will create a rebutable presumption of price gouging against firms that exercise unfair leverage and companies that brag about increasing prices during periods of inflation. Let's back up here and talk about the theory of price control. Does it work?
No.
Okay.
One of the fun things about it, I love Elizabeth Warren. She nicely encapsulates every fallacy about inflation that was told since Emperor Diocletian, and I think it was the 6th century. His immediate response to inflation caused by his overspending was to put in price controls. And every inflation, along comes the witch hunt for the hoarders, the middlemen, the price gougers. This one was hilarious. I think think it was Senator Warren who went after the chicken producers for raising the prices of chickens, the great chicken monopoly. That's why we have inflation.
Right, I heard that.
If they could have raised prices, why didn't they raise prices already? Was there a sudden outbreak of greed that, all of a sudden? The fundamental economic mistake there is to mistake relative prices for the price level. And we do that all the time. And this is important. Inflation is always comes at a time of chaos when one price relative to another is moving, but those are different things. So when the price of chickens goes up relative to the price of something else, that's not necessarily inflation. That can happen by the price of chickens going up or by the price of something else going down or a little bit of both. This is the big supply chain stuff happened. When you can't get TVs through the ports of LA, the price of TVs has to go up relative to wages. But that could happen by wages going down or by both of them going up or whatever. The phenomenon of inflation is the part of all this where all prices and all wages are going up by at the same amount. On top of that, there's all this noise and chaos. But don't confuse the noise for the fundamental issue of inflation.
But in theory, Professor, if let's say the government in a command economy were to mandate a certain price level or prohibit companies, both public and private, to raise all prices above a certain level, let's say 5% a year. Assuming companies comply, in theory, we wouldn't have inflation above 5% a year, right? Or above 5%. I mean, is that too simplistic?
And what you get instead is shortages. We've tried this over and over again. The U.S. did this in the 1970s. President Nixon, a good Republican, goes down in history as the most recent person to try to do nationwide price controls. And it's been an effort all along. They do it during wars all the time to hide they print money to finance wars and then pass price controls to hide the inflation. But if you pass the price control, what you get is a line. More people want the stuff than there is to be there. So everybody goes and you need ration cards and coupons, and you pay for it not with money. You pay for it by your time of standing in line. And that's, of course, disastrous for the whole economy because everybody's wasting their time in line rather than out there producing goods and services. And then very quickly what happens is everybody runs to Washington to, oh, no, but my special brand of chicken feet needs an exemption from the price controls on chickens because we're so special. So you start getting political favors handed out. The next thing you get, of course, is a black market. And every country with price controls within months has a black market where you get what you want. That encourages, of course, the mafia, organized crime, who handles the black market. It's just an absolute mess and economic disaster. Like many such things, like rent controls, known as the surest way to destroy a city short of bombing. It works for a little while, and then it takes a couple months to a couple of years for all the bad stuff to break out. And then you give up in disaster and inflation shoots up again.
Okay, interesting. Now, how would you evaluate, going back to my previous question, how would you evaluate the state of inflation in the U.S. today? The CPI number on paper has been coming down. So is inflation still a concern for you?
Yes. Now, one part, I'll brandish another success of fiscal theory. There was a big question a year ago when inflation broke out because of fiscal problems, I think. But even if you thought it was supply chain shocks or whatever, and the Fed didn't do anything about it, was that going to cause a spiraling inflation? And the fiscal view says, this was a one-time rise in the price level, a one-time burst of inflation caused by the pandemic, $5 trillion. But once that's over, it's over, and inflation does go away. And inflation is moderating. But I'm still worried because we still have, ongoing $1 trillion deficits. It's absurd. It's right for the government to borrow money in a crisis and then pay it back. There's no reason in the world the U.S. government should be borrowing $1 trillion at a time when the unemployment rate's 3.6%. So we have ongoing fiscal issues that I think are going to lead to ongoing inflation. I hear crystal balls are hard. The one thing every listener should understand is that no one can forecast inflation, and me neither. One, it's inherently hard to forecast because it's like forecasting stock prices. If everybody knew that prices would go up tomorrow, they would have raised their prices today. So, number one, you got that mechanism that makes it hard to forecast inflation. The other thing is inflation is largely about forecasting the next shock that hits. So if China invades Taiwan and we lose and we don't win this war against Ukraine and there's a new pandemic, there's going to be some inflation. But I don't know whether those events are going to happen. And what happens in Congress has a lot to do. I don't know what our politicians are going to do. So if you're forecasting as an investor, number one thing you need to recognize is the uncertainty about it, that nobody really knows, and that it is dependent so much on what kind of political and other events hit us. But I worry about ongoing inflation. But sort of a 1975 scenario, we get a mild recession. Well, that one was a deep recession, but it comes down to about 4%. And then sits there till something bad happens. I think that's a likely scenario. I won't call it a forecast, but a likely scenario.
Well, so the forecast aside, I mean, not counting black swan shocks like you mentioned, how would you evaluate the overall health of the underlying economy behind those inflation numbers you just brought up? Basically, on a scale of Japan to Venezuela, where do we sit?
I can think of better things than Japan, and even I can think of worse things than Venezuela. So there's two issues here. The one issue is the issue of where are we on the recession scale? Again, these things are hard to forecast, okay? But there are the mechanisms. Typically, a real recession doesn't break out unless there's some sort of financial clogging up. Now, the Fed started raising interest rates, and the co-pilot failed to ask the passengers to fasten their seatbelts. What I mean by that is, astoundingly, the regulatory arm of the Fed did not ask the banks if they were okay with raising interest rates. The regulatory arm of the Fed was asking banks what happens if interest rates go down. So we have this problem that now raising interest rates may well lead to some financial tightening. And I would look for that before you get a serious recession out of the interest rate rising. But I think we keep forgetting, everybody thinks it's 1933. Everyone worries about jobs when there's a 3.6% unemployment rate. And we're worried about recessions when the real issue for the US and the rest of the world is long-run growth. And the issue for paying back our debts is long-run growth. It's not this year's deficit. It's not this year's recession. It's why is it that from 1950 to 2000, the U.S. economy grew about 4% a year, and now it's growing about 2% a year and headed down. Europe stopped growing in about 2010. So the revival of long-run growth is really the most important economic issue. That'll make our fiscal problems just go away. If we could start growing 4% a year again, the tax money will be rolling in. The spending will go way down because everybody's happy. That's the thing we ought to be talking about. And that long-run problem, I don't see any. It takes basic, simple reforms like your grandmother told you about how to run your life that Washington doesn't seem very interested in.
I think a layman might ask you, John, why do we need to target 2% or 3%, 1% or 4%? Why can't we target deflation? Can we still have long-run growth with lowering prices? I mean, in theory, if we have that combination, wouldn't everyone's living standards just increase?
Yeah. Where does 2% come from anyway? That's a great question. There is this sort of fear of deflation that I think comes again out of 1933, where it's like 30% deflation and things weren't so great. The last half of the 19th century was like a steady 1% deflation. The U.S. economy didn't fall off a cliff. Where'd the 2% come from anyway? The mandate to the Fed is price stability. Now, without getting too textualist about this, how do they turn price stability into perpetual 2% inflation? I actually know where it came from. When New Zealand went on an inflation target, they kind of picked 2% out of thin air and everyone else picked 2%. And once you pick the number, it's really hard to change that number. So that's how I got stuck at 2%. There's a lot of economists like 2% because it's the theory that wearing shoes that are too tight during the day makes you feel better when you take them off at night. If in normal times you have 2% inflation and a 1% real rate, so a 3% nominal interest rate, then you have, in a recession, you can lower that nominal interest rate 3 percentage points, hit zero, and sort of stimulate the economy. But why does the amount of stimulus that a 0% rate gives you have anything to do with what inflation and the interest rate was 2 years ago? Well, I don't see the logic for that. That's the logic given for it, to headroom to lower rates in a recession. But I think we would be just fine with not just 0% inflation, a steady price level, meaning if you get a little bit of inflation, work it back off again so that the price level 20 years from now is the same as the price level is today, slowly and steadily. That makes a lot of sense. And yeah, steady deflation. Milton Friedman called that the optimum quantity of money. And his argument was very simple. At a negative 1% deflation, then money and bond, then the nominal interest rate is zero. Money and bonds are perfect substitutes, and you don't have to spend any time worrying about cash management. Just hold a lot of cash. Liquidity is valuable. Why should we not have all the liquidity we want? We get that now with interest on reserves and interest paying money, but 0% has zero inflation, slight deflation. There's some advantages there. You're not in a hurry to collect your bills. You save a lot of effort there. So yeah, long answer to a short question. There's no real reason that we shouldn't go for zero or a steady price level, at least in my view.
I understand that you are also a research associate at the National Bureau of Economic Research, which is, for our listeners, the body of thinkers that officially designates recessions in the U.S. I think a common misconception is that the NBER only looks at GDP data. And so once you have 2 quarters of consecutive negative GDP growth, it's a recession. Well, that wasn't really the case because we saw 2 quarters of negative GDP in last year, and that there wasn't technically a recession. So what other variables does the NBER look for?
Well, so I'm not part of the business cycle dating committee, and there is no official recession. They got themselves a great job of branding. They made themselves the designator of recessions. And there's this sort of concept that a recession, what is a recession? It's not just GDP going down 2 quarters in a row. It's this idea that there's a widespread contraction in economic activity across many industries, across the whole country. Persistent, involving loss of jobs, the labor market. And so they kind of get together and light some incense and wave some dead chickens around and look at the numbers and decide if a recession's come along. And I think we're right, that whatever that poorly understood phenomenon is, hasn't happened yet. And they'll be sure to proclaim it when it does. But, unless there's a financial convulsion, I don't see anything but a small technical. There could be a financial convulsion. The debt ceiling business could lead to a financial convulsion. Recessions need a shock. They need something bad to happen. And until that something bad happens, a slowdown is likely. But then let's stop paying attention to next quarter's numbers and start paying attention to why is long-run growth cut by half. Americans have lost 25% of their income. If we'd kept growing at 4%, like we did till 2000, we would each be 25% better off than we are today. And this keeps going, and it's disastrous for the long run. So I really, this is where I'm being like a politician. So you asked the question, I want to change the question back again to there are more important things than recessions to worry about.
Well, yeah, you did bring up a good point. So let's close off here. What happened to our incomes? How did that number come about?
Yeah, well, that's a good question, and economists debate. So I don't want to offer what I'm doing is. Some people think we just ran out of ideas. I think we got plenty of ideas. We got plenty of capital. We got plenty of smart people. You just can't get the permits anymore. That the costs of the far too active regulatory state are really slowing things down. The number of industries like health, banking, and increasingly tech that are falling under the government's domain are really slowing things down. Everyone runs to Washington rather than go out and make a better product. So I think that's the fundamental source. That's debatable, especially in the last couple of minutes of an interview. But at least let's tee that up as over the long run a far more important question.
Well, do you think that living standards have increased over the last 4 to 5 decades?
Yes, and a lot of that. There's a lot of massaging the numbers that says that's not true. No, living standards have increased tremendously, especially once you get 4 to 5 decades, not just 2 decades. The median American, the middle class, are the true numbers on that are tremendous. gains, in part because of the quality of stuff. We don't just have 3 Ford Pintos instead of 1 in every front yard. We've got just tremendously better stuff all around. So, and globally, we shouldn't be. I'm glad you brought this up because the tone of my comments was too much worry warding. The rise of China meant 1 billion people went from unbelievable poverty. I mean, plowing by hand a 1/4-acre plot, trying to raise enough rice to not starve next winter, to middle income. They got about $20,000 a year to our $60,000 a year GDP per capita. The disappearance of global poverty is astounding. Lifespans are growing everywhere. Health is growing everywhere. It's been a great 40 to 50 years, but things could be better still, and that could be wider shared. And so I just want us to get back to that kind of growth.
So final question, if you were to wave a magic wand such that the government could do anything you want, businesses could do anything you want, and your objective is to fix all the pockets of the economy that need fixing that you mentioned, and increase our living standards even more, bring our income levels back to the real levels they were before, what would these things be?
Well, that's the problem with supply side microeconomic, free market, incentive-oriented economics, whatever you want to call us. It's like we need a great Marie Kondo cleaning up of our public lives. And the trouble with the Marie Kondo is first you got to do the sock drawer, and then you got to do the t-shirt drawer. And oh my God, here's the garage. It's hard work, reforming the zoning laws, reforming the labor laws, reforming occupational licensing, reforming the Environmental Quality Act. It's not, Keynesian economics is so attractive to politicians. I'll just spend a ton of money and send you all checks and we're going to be great. Isn't that lovely? That's a great way to get reelected. We're going to do the hard part of changing California's zoning code so you're actually allowed to build houses. Oh boy. And then you got to change New York's zoning code. And then you got to change, it's reform is hard work. And that's unfortunately not a magic wand. The magic wand is we need, this is why I operate. This is why I'm talking to you. We need voters who understand this and will reward politicians who say, I'm going to do the hard work of cleaning up 3 little messes, and would you please reelect me, rather than I'm going to promise you some magic wand that takes us to the moon.
A big topic to unravel next time. What to demand of our politicians. But Professor Cochrane, I really appreciate your time today. So where can people follow your work? You mentioned, first of all, I'll put the link to your book below. We can purchase it on Amazon, I believe, and other websites. But you mentioned you have a website yourself.
Yes, you can. If you just Google me, you'll find my website, johnhcochrane.com, with all my academic work, all my op-eds and stuff. And you can find the blog, The Grumpy Economist, which collects all of my observations on how the world works. So please.
It would be amazing if you could put your lectures on Stanford online as well. I'm not sure if they have a policy, an open education policy. I believe MIT has that. Harvard has that.
I do have actually lectures online. If the lectures I have are on my previous incarnation, asset pricing theory. Okay. So if you want an online PhD level course on asset pricing, it's right there on my website. And good luck to you.
Okay. Good luck to us. Good luck to the economy. Thank you for your time. Thank you for your assessment of our economic state. I appreciate it. We'll speak next time.
It's been a great pleasure. Thank you.
And thank you for watching. Don't forget to subscribe.